Here's a number that sounds almost too good to be true. Some car washes clear gross margins above 80% on a single wash. That's a better margin than most restaurants, most retail stores, and most service businesses will ever see. So, why did Wall Street suddenly start paying attention to a business built on soap and water? The short answer is the number itself. The United States car wash and auto detailing industry generated an estimated $20.7 billion in revenue in 2025. And according to industry data compiled by Matthews Real Estate Investment Services, express car washes, the drive-through conveyor-style tunnels that have replaced most old-fashioned hand washes, can post net profit margins between 40 and 60%. For comparison, an NYU study of average net profit margins across American industries puts a typical business at just under 8%. A well-run car wash, in other words, can outperform the average American business by a factor of 5 to 7 times on a service that costs a few dollars in water and soap chemicals to deliver. To understand how that's possible, you have to understand what actually happened to this industry over the last decade. It used to be one of the most fragmented mom and pop categories in American small business, tens of thousands of individually owned lots, each one competing on price and location. Then private equity discovered a detail almost nobody outside the finance world had paid attention to: the monthly membership. A modern express tunnel doesn't primarily make its money from the driver who pulls in once and pays $10 for a single wash. It makes its money from the driver who signs up for an unlimited monthly plan, priced somewhere between $20 and $40 a month, gets auto-billed every 30 days, and, according to industry data from car wash investment analysts at MMCG Investment, keeps that subscription running through minor economic downturns because the cost feels small relative to the convenience. At scale, chains like Mr. Car Wash, Zips, and Quick Quack now generate 60 to 75% of total sales from these memberships rather than one-time visits. That single shift from paper wash to recurring subscription changed everything about how this business gets valued. A car wash with 1,500 active members, paying an average of $30 a month, generates somewhere between $37,500 and $52,500 in predictable monthly revenue before a single transactional customer ever pulls into the lot. That recurring subscription-style cash flow behaves in the eyes of an investor almost exactly like a gym membership or a streaming service. It's stable, it's forecastable, and unlike a one-time car wash sale, it keeps arriving in the bank account every single month, whether the customer shows up that week or not. This is precisely why private equity groups have flooded into this industry over the past several years. Their playbook is remarkably consistent. Buy a portfolio of individually owned car washes, often from an aging owner ready to retire with no succession plan, consolidate them under a single operating brand, then sell off the underlying real estate through what's called a sale-leaseback transaction. In a sale-leaseback, the investment group sells the physical land and building to a separate real estate investor, then leases it right back to run the car wash on top of it. This does two things at once. It returns a large chunk of the acquisition capital immediately, and it turns the property itself into a completely separate, passive real estate investment for someone else entirely. A structure that has created an entire secondary market of investors who own car wash real estate and have never once operated a car wash in their lives. So what does it actually cost to build one of these from scratch, and what can a well-run one realistically earn? A well-located express tunnel car wash, according to 2026 industry data, can gross between $1.5 million and $4 million annually, with operating margins landing between 35 and 50%. On the lower end of that range, a location grossing $1.5 million a year at a 35% operating margin nets roughly $525,000 in annual operating profit. On the stronger end, a location grossing $4 million at a 50% margin nets $2 million. That is an extraordinary range of outcomes for what looks, from the outside, like a nearly identical business, a building, a conveyor belt, and a line of cars. The gap between those outcomes comes down to three specific levers. According to industry benchmarking from Vanta Insights: revenue per vehicle, throughput volume, meaning how many cars physically move through the tunnel per hour, and membership penetration, meaning what percentage of total customers are paying subscribers rather than one-time visitors. Operators who control all three consistently outperform the industry average, While the gap between a median performing car wash and a top quartile operator isn't incremental, it's structural, driven by format choice and labor efficiency that no amount of small operational tweaking can fully close after the fact. None of this comes cheap to build in the first place. Financing an express tunnel car wash typically runs through Small Business Administration loan programs, with the SBA 504 program requiring around 10% down for an existing wash and closer to 10 to 15% down for new ground-up construction, while the more flexible SBA 7A program can finance up to $5 million, though conventional lenders in this space often still require 25 to 35% down given how capital-intensive tunnel equipment and real estate acquisition can be. This upfront capital intensity is precisely why the individual mom-and-pop operator has become rarer and the well-capitalized regional chain has become the norm. There is, however, a limit to how far this consolidation wave can run, and it comes down to the same word that shows up in nearly every business we've covered on this channel: saturation. The car wash industry remains highly fragmented, with roughly 19,800 separate establishments across the country and no single operator commanding a dominant national share. A market with 3 well-run express tunnels serving a population of 100,000 people is generally considered saturated. The same market with only 1 aging tunnel and a handful of old-fashioned hand washes still has genuine room for a new, better capitalized entrant. This is why, even amid heavy private equity buying, individual investors and smaller regional operators continue opening new locations, betting on markets the larger chains haven't fully reached yet. So let's run the actual math on 2 realistic versions of this business. Option 1, a single independent express tunnel in a mid-sized market, built with roughly $2 million in combined equipment and leasehold investment, financed through an SBA loan with a 30% down payment. Grossing $1.8 million a year at a 40% operating margin, that's $720,000 in annual profit, a genuinely strong outcome for a single location, assuming membership penetration stays healthy and the lot avoids serious local competition. Option 2, a regional operator running 6 locations under one brand, built through a mix of ground-up construction and acquired independents, each location averaging $2.5 million in annual revenue, with membership penetration above 60% of total sales. At a blended 45% operating margin across the portfolio, that's roughly $6.75 million in annual operating profit before corporate overhead. Precisely the kind of cash flow profile that attracts the private equity buyers actively shopping for regional car wash chains to roll up into something even larger. The car wash business works because it solved a problem almost no other local service business has fully solved, turning an occasional, discretionary purchase into a recurring, forgettable subscription that customers rarely think to cancel. It does not work the way it looks from the outside, as a simple lot with a conveyor belt and a line of cars on a Saturday morning. It works because someone figured out how to make washing your car feel less like a purchase and more like a bill, quietly renewing in the background every single month. Not bad for a business built on water, soap, and a subscription almost nobody remembers signing up for.